Hello, everyone. Thank you for joining us for another episode of On the House with Spartan Invest. Today, we have a special guest. We have got Richmond Stecker, who is joining us. He is the CEO and founder of USA Cost Segregation in Sedna Data Corp. He's been leading the charge in commercial real estate tax strategy and technology innovation. He's got a deep understanding of cost segregation, tax credits, real estate investment, and he's worked with developers, REITs, commercial, residential brokerage firms, just everyone. Thank you so much for joining us, Richmond.
Of course, Lindsay. Thanks so much for having me today.
So tell us a little bit about yourself, other than what I just kind of shared with the audience, but tell us, how do you got into cost segregations and into real estate?
Yeah, so cost segregation is a very niche tax strategy, and then I often get asked, how did you even find out about it? I was a mortgage broker in South Florida starting in 2016, and I did that for about 3 years, and then Quicken Loans came around, Rocket Mortgage, and I more or less saw the writing on the wall, and I realized I'm going to be outdated soon. I've got to find another way into this market. And my background is finance and financial accounting. So naturally, I just kind of looked for a tax strategy that I could really work with. Found cost segregation through a couple of real estate friends of mine, and realized how uncaptured the market was as a whole and how few investors were using it that should be. It was an educational issue at the time. And I think since then, over the last 7-8 years, people are more understanding of it. CPAs understand it, and we're seeing it used a lot more by the broader market, not just these big CPA firms with their in-house departments.
So you're the first person, like you said, it's become a lot more common, and a lot more of our investors are utilizing it. But you are the first one to come on this podcast and discuss cost segregation. So for our listeners, kind of explain very high level in basic, simple terms what cost segregation is.
Yeah, so stop me if I get too nerdy. I could talk tax all day. But essentially what cost segregation is, it's an alternate method of depreciation. So typical depreciation that every accountant's going to use when they're looking at a commercial property or residential investment property is going to be straight line depreciation. What that just means is they're taking the basis of your property and they're depreciating it equally over either 39 years for commercial property and 27 and a half years for residential. Back in 1993, the Hospital Corporation of America said, nope, can't do that. We have all this equipment that is bad after 5 years, and we're never really seeing the return on that. So fast forward a little bit, cost segregation came about really in 2004 when the IRS started recognizing it and released a guide. And it allowed investors to separate different parts of their property into shorter depreciating class lives to kind of fulfill that need to retire assets at a shorter time period. So through cost segregation, you're able to accelerate the depreciation that you'd normally take on an asset, which boosts cash flow. It gives you more money to invest, and it helps you boost the return on investment overall.
So when you're saying depreciation, so let's go a little bit more depreciation in regards to your overall tax strategy. Explain why an accelerated depreciation would be beneficial versus the 27 and a half years for single family.
Yeah, so essentially what you want to do is you want to pull out as much money as you can from the tax man that's possible, right? And so if you're looking at investment, let's say it's a $2 million property and you're taking maybe 20% to land, and then you're left right there with 1.6 million as your basis to depreciate. So you can either take little chunks of depreciation to offset your passive income, or you can take a big chunk of it in the first year, which allows you to mitigate that tax and invest that money into other active investments, whether it be stocks, more real estate, or just keeping the financial house in order. So for cost seg, we look at two types of property. We look at 5-year property and 15-year property, essentially as short term. So 5-year property is going to be anything that's inside the building that can be taken away and not damage the structural component of the asset. So for just to give a light example on a rental property, if you have vinyl flooring, all of that vinyl flooring is called short-term property under the IRS regulation. Therefore, you can depreciate over 5 years versus 27 and a half years. So you're getting the full value of depreciation over a significantly shorter time period. 15-year property is any of those land improvements that you did on the rental property for the sake of having it rented, right? So if you did landscaping, if you spent money with a landscape architect, if you did certain paving, all that can be considered 15-year property, which is also short term. Now, where it really gets interesting is when you look at the bonus depreciation regulations. So right now, as it stands, we're in 40% bonus depreciation. That means everything that we separate into 5 and 15-year property can be taken, 40% of that can be taken in the first year. We're very confident that we're going to switch back to the 2017 TCGA and go back to 100% bonus depreciation, which will allow investors to take all of that short-term property as a deduction in the first year. So just a basic mathematical example, just to make it easy for reference. If you have a commercial property that depreciates over 39 years, it's $1 million. Say your basis is 800,000 minus land, right? Your deduction is going to be around 22,000. With cost segregation, you're looking at a deduction in the first year of anywhere between 160,000 to 250,000. So that can significantly offset your tax burden, if not completely eliminate it, and give you depreciation if you don't use that full pool to carry forward into the next year to continue to defer taxes on that income.
Gotcha. Can any property qualify for a cost segregation study?
Yeah, so when it comes down to what properties can and can't, it's more so we need to look at the investor themselves, right? So any property that's either a residential investment property or a commercial property can use cost segregation. Now, if it's your primary residence, unfortunately, we can't do a cost segregation on that, and we can't enhance the depreciation. But there's no one size fits all decision for whether or not it's a good property for cost segregation. Some are better than others. And that's because you have more specialty equipment. So for instance, a medical building, there's a lot of medical equipment, there's a lot of accent lighting, and a lot of that adds to how much of that you can convert to short-term property. But really everyone can do it, every property can do it. It just matters whether or not it's taking off your passive income or if it's taking off your income as a whole. And that comes down to whether or not you're a qualified real estate professional. But we can get into that at a later date and focus on passive income for now. So anybody that owns investment residential real estate or commercial property can use cost segregation. It's just deciding whether or not it's the right fit.
So when would be the best time to do a cost segregation study? Would it be like right after you purchase the property, or is there a time frame? Go into that a little bit.
I always say the sooner the better.
Okay.
Part of the reason why it's better to do a cost seg as soon as you have the property is because then you have an opportunity to dispose of any assets that you might get rid of for a renovation. When you do a renovation, you're adding assets into that building, right? So say I purchased a property in year one, I do a bunch of renovations in year two, but I never did a cost seg. Now we have to go back and we have to look at what the basis was, do a partial asset disposition. It just becomes a lot more complicated. But if you do it in the first year, it's also really helpful for your accountant, because if you do it in the second, you are going back to modify your tax return. So your accountant would have to file what's called a Form 3115, which is just notifying the IRS that there's a change in accounting method. It's not a big deal. It's not that difficult, but I'm sure most accountants would like me to tell people, do it in the first year so you don't add to their workload. And it also helps you strategize better, right? So if I know exactly what I'm getting into from the start and I know how much depreciation I'm going to have, it's going to give me a much better understanding of how to treat that investment throughout the years.
So let's say that you own a rental property for an extended period of time. And use one of our examples, mine and my husband's example, in that we purchased his grandmother's house from his family after she passed. And there were already tenants in there, so we just let it ride for a while. And then when they moved out, we did an extensive renovation. Would that be the time to do a cost segregation study, or is that too long of a period post ownership? How does that look?
So it's a great question. It's great to do it after the renovation as well. What we're really focused on when we decide whether or not it's a good time or not to do it is how much depreciation has already been taken through straight line. So say you and your husband had that property for 10 years. Depending on how much money you spent on the property, so say you spent $500,000 on that property. and you had it for 10 years, that means you use straight line depreciation for those 10 years. So every year your basis got a little lower and lower. So then you approach this time value of money situation where you go, okay, I've depreciated it so much already. I could just wait another 17 and a half years and still get the full depreciation. Or do I want to accelerate that and get the tax benefit now? And it's unique for every investor, really. It depends on what their strategy is. If they want to hold the property and just, collect that income and they're fine with it. But what I'd usually tell people is if you've owned it for 5 to 7 years, let's do a cost seg, go back, see if we can get any money back from the government that you paid, because we can go back up to 3 years. So let's go and see what money we can get back. And then let's do a 1031 exchange, get a new property and restart that clock. Because depreciation can be your best friend or your worst enemy. It's whether or not your assets are over leveraged or under leveraged. And once you reach a certain time period, it becomes over leveraged. So we really want to give people as much tax benefit as they can. And the best way to do that is by rotating those properties every 5, 7, 10 years.
So this would be, it sounds like, so if you're a real estate investor, if you're an active real estate investor, if you're just buying passive rentals, let's say you've had a year where your taxable income is going to be significantly higher than maybe previous years, that would be an ideal year to do a cost segregation to help that particular year. So you may not need it every year. Would you say that that's correct?
In a way, one of the things that we have to think about in that is that, yes, we can go back 3 years to capture any depreciation that should have been taken had you used cost seg. But the other thing we need to look at is how much depreciation are you going to get, because we can carry it forward 20 years. Right. So think of it as like a piggy bank. If I have $500,000 of depreciation and I only have maybe $100,000 of tax that I need to pay, it's going to wipe out that tax and you can carry forward those depreciations into the next year. So the timing is all about planning. And that's why we say treat cost seg as more than a service and more than a product, but as a strategy. And that's what we help investors do. We help them build out that strategy on paper so they know exactly what they're going to expect each year as tax. They're going to know when that property becomes over or under leveraged. And we really try to provide them with different strategies, whether or not it be selling and doing a 1031 or selling and doing a 1031 into a DST. Maybe they don't want to be involved in real estate as much anymore. There's a lot of different ways to look at it. And one of the things that, we'll probably end up doing is pushing a lot of our clients that want to move into triple net leases and turnkey operations over to Spartan Invest. Because some people, they just don't want the headache of managing the properties and dealing with the day-to-day operations of it. They just want to be passive.
Right. Yeah, that's our bread and butter. Those that want to, dip their toe in, they want to be real estate investors, but they may not have the time, the resources, or even live in a market where it makes sense, where the yields are not ideal for real estate investing. So that is definitely what we offer. And I see that, and I say, hey, use it in a year where your taxable income may be increased, because we see a lot of investors that do that. They'll come to us in the third and fourth quarter and it's like, hey, look, I've made a good bit more this year. I want to buy a new construction home and do a cost segregate. Like, they'll do that as part of their strategy within a better year. And so we tend to see that increase substantially kind of going into the third and fourth quarter when those investors are seeking that option. What should investors look for in a cost segregation provider? Like, if they're interested in doing this, what does that first step look like?
So that's an amazing question. That's kind of, I guess we can get into a little bit of why I started this company in the first place. So I've been in this industry for about 7 or 8 years, and I came from my godfather was in cost segregation, so I was kind of, I got the background information in the market. And what we've seen is because of the lack of knowledge in cost segregation, both on the CPA side and on the IRS side, we've seen a lot of providers just come out of the woodwork in the last 5 years that want to say, hey, we can do cost seg. We're best. We've done 4,000 or whatever the claim may be. But when it comes down to looking for a quality provider, you want to make sure that, one, they're using an engineering-based method. So there's multiple different methodologies you can use for cost segregation, because what you're essentially doing is, as a cost segregation company, we are reverse engineering your entire asset. So basically, think about it as, when you do construction estimation, you're building out the blueprints for a project. We're doing that in reverse, without the blueprints and without the information. So we have engineers that are trained to go in and basically build that from the ground up on paper and allocate assets appropriately. If it's not an engineering-based cost segregation study, there's a lot of estimation that goes into that, and it gets a lot less accurate and a lot less beneficial, because you're not looking at, say, and this is going to be a very technical description, but let's say you have a restaurant and you have all these beer lines, right? You have to have a cost segregation expert that can go in there and not just, account for the taps, the lines, but also all of the electric that runs that, all of the drainage systems, because all of that is a part of an asset that was just installed for the sake of doing business. So where you could have gotten maybe $100,000 deduction for that, system, you might only get a $50,000 or $25,000 deduction if you don't go with a provider that really digs deep into the actual engineering of it. Secondly, I think what's most important is looking at quality over quantity. I mean, it's great that, some of these companies say, we'll do a study for $2,000 and we'll just do a virtual site inspection. That's a big red flag. If anybody says they're going to do a virtual site inspection on your property, I'd probably turn away, because the IRS does not recognize that as a valid method of assessing a property. So you have to be in person. It has to be an engineer or a qualified inspector. And then from there, that's your baseline, right? So you want to make sure that they're at least coming to the property, they're taking pictures, they're being thorough, because if they don't see the electricals, if they don't see the breaker boxes, they don't get into the plumbing, you could be missing out on substantial deductions. Another thing that you want to look for, and this is kind of where we pride ourselves, is audit protection. And nobody likes to say audit. Nobody likes to talk about it in this industry. They want to stay 10 feet away from it, but it's an inevitable part of, paying taxes in the United States. Anybody can get audited, and, you have to be prepared in that situation, because when the IRS comes, they start turning every stone. And if you had a bad provider that didn't do their job properly, maybe didn't do the site inspection, or maybe used a not advanced or didn't adhere to the correct methodology, you could face a penalty on the back end for that. And the IRS associates 100% penalty with those disqualified deductions. So audit support is really important. Having a cost segregation company that's going to come out there, defend their results, is super important. And we are actually the only company in the United States that will actually pay any disallowance that were associated with our deductions. So we make sure that there's no possibility for a net negative for our clients. I've never had to do it, knock on wood. I've been through around 12 to 14 audits. I almost look forward to them. I love teaching the IRS what I do. But we've never had a change, and we stand on our work, and having a provider that's going to do that is super important.
Man, I cannot stress enough to how much validity that'll carry with investors is that that type of protection, that you would see it through a potential audit and then cover expenses if it does go the other way. I mean, that's a huge benefit, because that's a risk. And I know a lot of investors would be skeptical of taking an additional deduction, especially one that's kind of relatively new, that maybe the IRS is not 100% keen on or understanding. So that's a very big benefit, and we see that a lot too with other turnkey providers. When the market's great, they'll pop up and they do these renovations, and then we get calls from investors like, hey, can you manage this property? This wasn't renovated correctly, or et cetera, et cetera. So it's very similar, and that you have a lot of people, and there's these things to ask and be aware of. So an engineering and actual physical inspection, and then an audit protection, I think, are great takeaways for those looking for cost segregation providers. So who would you say is the ideal investor for a cost segregation? I mean, we talked a little bit about the benefits, the accelerated depreciation, and how it could fit based on your income, maybe for a year or something like that. But your overall ideal investor, say, hey, this is for you. Who would that be?
So for us, and I think for anybody in this industry, the ideal investor is an aggressive investor, somebody that wants to build their portfolio and maximize their benefit. We partnered with the strategic group so that we could provide a holistic tax strategy. So we do tax credits, we do 1031 exchanges, we do DSTs, REITs, you name it. But we want people to get into real estate and not just get into it so that they can have some extra money on the side, but really treat it as a tool to build generational wealth. So that's why we build out strategies for our clients. We actually, before going into any project, we do a thorough benefit analysis. We map out year by year how much you're going to save. We include discount factors. We account for tax rate. But we do that so that we can treat this as a strategy and not just as a service, because our ideal investor is somebody that wants to continue to do this and continue to grow their portfolio and their earnings.
An aggressive investor. I love it. Thank you so much. So as we get ready to wrap up, talked about just how this plays with the investor seeking the passive income. How does this contribute to the overall passive income that you can get from real estate?
Yeah, so cost segregation, like many tax strategies, is also still has to adhere to the passive or active investing status. So for passive investors, cost segregation is perfect because you're taking in all that passive income and you're easily mitigating it, because the deductions that you'll get from cost segregation on passive income are going to be more, and they're going to offset that passive income almost every time. For the active investors, right? So that's somebody who has qualified real estate professional status. That means they can take this off their W-2 income. They can take this off other partnership income, pretty much wherever they'd like. So cost segregation for them is great, but it might not knock out their full tax burden for that real estate income. Whereas a passive investor, cost segregation is a great way to make sure you have that stream of money coming in and you don't have to worry about paying taxes on it. So that's kind of how it works with passive investors. I think, for cost segregation purposes, passive investors get more of a benefit because it knocks out their entire tax liability on that income, and they just get to see that money come in and not worry about it.
No, that's great. Thank you so much, Richmond. So for those that want more information or to learn more about you and your company, what's the best way for them to get a hold of you?
So you guys can go to our website, www.usacostsegregation.com. You can schedule a meeting with our team from our website. We have plenty of educational material on there. And you can also email us directly at info@usacostsegregation.com. If you just want more information, we can provide documentation, especially when it comes to how do you look for a good cost segregation provider. We're very competitive, but we don't mind. We don't mind competing. So we'll give you the tools. We'll give you a handbook on what do you need to evaluate these people for. Just send us an email or schedule a meeting through our website. We're always open to help, and we do free benefit analysis. So if you're just somebody that is just getting into it, you're not sure what to expect, don't worry. Just give us a call, send us an email. We'll do an analysis and figure out if it's right for you. And if it is, great. If it's not, that's okay.
Awesome. Well, thank you so much for joining us and diving into cost segregation, Richmond. I appreciate it.
Well, thanks so much for having me, Lindsay. And hopefully next time we can get into the nitty gritty.
Yes, I'd love to have you back on and we can dive a little bit more into the details for our listeners. All right, guys,
Certainly.
That's another episode of On the House with Spartan Invest.